just because of a lot of the technological and demographic changes going on. And kind of what we try to think of what's inspired this is that we just try to harken back and think a little bit. And we go back to those of you who are Star Wars fans here. A long, long time ago, in a galaxy far away, this is where we did most of our shopping. And we're all accustomed to go out on a Sunday afternoon or on the weekends to go out to your local mall, down to Sears, JCPenney's, remember Woolworth and Montgomery Wards. Many of those kind of line up the graveyards of once known great retail establishments that have once been dominated by online commerce because essentially people have grown accustomed to shopping and buying on their phones and on Amazon.com. And so these have caused what we call radical transformational changes to the way people shop and transact business and how it applies to, as well as our profession as tax practitioners, and as well as those state and federal taxing authorities of essentially their tax base has been eroding as a result. Because in a traditional world where we have brick and mortar retail, we knew in terms of we had a transaction, we knew where it occurred, and then we would also have assess and legislate tax rates accordingly to that jurisdiction. But now in terms of in a virtual world, we have essentially created a large swath out there of commerce that escapes taxation. And thus what you look at in a real world context is that you can have what's called a shrinking tax base. And this is really the bigger issue of our time than anything else in trying to address taxation in a modern world. What we're going to address in terms of today is I'm going to talk about the 4 pillars of the virtual world. We're going to kind of highlight in terms of this, since this is about a 5-hour workshop, we're going to talk about virtual business. We're going to talk about virtual workers, virtual investing, and we'll conclude the day with what I call virtual currency or virtual money. So we're going to kind of highlight what those 4 key pillars are and how they come together in terms of in this and basically where we're at today in 2018 in terms of tax rules or rules yet to be created. Because keep in mind, technology, products and services are very fast in terms of innovate, but our regulations, our laws tend to be slow to keep up. So this is where we're going to highlight and survey where we're at in terms of today. If you have any questions during the presentation or any time, feel free to raise your hand. We're a small enough group, we can address your questions or any particular concerns that you have. Okay? So a lot of the emphasis when we talk about in virtual commerce and e-commerce predominantly affects what we call sales tax. Now, as we're thinking in terms of today where we're in Arizona and I'm from California, and we can take that across in almost any state, when you look at as a share representation of the tax collections for any state, this is from the U.S. Census Bureau, so this is what we'd say a sampling of all 50 states. You look at basically sales and use tax tends to be about 32% on average. The income tax tends to be about 36%. So if we're going to take that out, for most states in the U.S., it's a third of their revenues. And when you think about various states out there that boast in their headline, Texas, Florida, Washington, Nevada, that they have no income tax, what does that mean to you as a tax practitioner? No, that their budget has to rely more on sales tax, right? Because there is no free lunch, right? Maybe the headline number says, come to our state, we have no income tax, we have no corporate income tax, but we have to rely on property taxes, right? Or sales tax. But when we're talking about in e-commerce, that's a large group of people who don't pay taxes. So if your sole source of revenue is sales tax, It just means that enforcement is that much more imperative. Does that make sense? So think about our bordering state of Nevada. They're what we call a no business, no personal income tax state. They rely a lot on property and sales tax. So they have to rely more on enforcement. And when we're talking enforcement, it's what we call the out-of-state or non-brick-and-mortar retailer, which can be anyone who throws something up online on a website. Okay? So when we look across the map of the U.S., this gives us kind of a representation of the typical sales tax rate. As you see, most states kind of hover between 7.5%, 8.5%. As much as people talk about California having high taxes, we don't have the highest sales tax. We have relatively low sales tax. But when you look at other states, typically like Alabama, Louisiana, who have lower income taxes, they have much higher sales taxes. And the reason why their sales taxes are higher is what's different is that in addition to what's called their base rate, they have what's called a county rate. Here in Arizona, you can relate is that I can file taxes for the state of Arizona, right? But I also have to register for Phoenix. I have to register for Gilbert, Tempe. So we have what's called a local home base rule. And so not only do we have a higher, what we call overall rate, it just adds to our administrative burden because I don't have one return, I have two returns, right? And so that's what creates the uniqueness, and in many of these states you have that apply as well. So here is, in terms of in the times that we're in, what's important is knowing is what the trend has been in terms of overall tax collections. So if we look at much of the map, the red signifies shrinking tax collections. And look at that map and take it in for a moment. That is a large portion of the continental U.S. that has shrinking tax collections. When we look at the minority of states, as we see California, Texas, up New York, that's increasing tax collections year over year. So again, this is the overall impact that we look at the trajectory as a result. It's not because population, not because the economy, that's again is what we call a shrinking tax base, is that we have a large swath of commerce and business not going through traditional channels of taxation. And this is what adds to the overall shrinking tax base. And so, for example, in Arizona, they've been experiencing, on average, a 10% decline in their overall tax base in terms of collections. So the fundamental issue that it comes down to is when states are going to look at in terms of trying to improve their tax base, they have to go out and look at enforcement. And how does enforcement start? We talk about the concept of nexus. And nexus is essentially defined as the amount and degree to which business activity that must be present before a state can tax one's income lawfully. So we basically state and we start from there. And as we're talking in today's context, we're going to be talking about multi-state business. So when you're talking to that client, if the client doesn't have nexus in a particular state, they don't have to remit or there's no taxation in that state, period. So what we have to, in terms of determine is, well, what kind of defines that nexus? So for much of the time that we've been operating on, goes back to an old court case, Supreme Court case of Quill versus the state of North Dakota, which was based back in 1992, in which came about, we have Public Law 86-272. And the basic threshold that we have been operating for much of this time, up until currently, has essentially established that the state can establish nexus on what we call a physical presence, okay? And physical presence was that basic threshold. However, if we compare from 1992 to fast forward to 2018, our imagination states that it's unreasonable to state that we would want to, for lack of a better term, hold true to the idea that if I'm not physically present in that state, I'm not really doing business in that state. Whereas back in the guise of 1992, during that time, we could say that I have an employee, I have a building, I'm physically there, what we call the true physical elements. Therefore, I'm in that jurisdiction. But again, this was in a world that predated the internet. This was in a world that predated a lot of the technologies that we utilize, that they use Skype, that they use, GoToMeeting, virtual private networks, all the different terms and means that allows and facilitates people to transact in a virtual means. This court decision was based in that world before all that existed, if that makes sense. So it seems like in 2018, and from various state legislatures, that's unreasonable to state that we have to hold true to the standard of physical presence. So, because this is not what we would call a federal decision or what we call law that came from the U.S. Congress, it was a Supreme Court decision. Essentially what we've had is a vacuum in these 25 years because states have been trying to expand beyond this definition because they feel at the end of the day, I'm being shortchanged. If I'm the Department of Revenue here in Arizona, I have all these businesses worldwide as well as in other states selling to my residents and my constituency that I don't have a means of taxing them if I hold true to this unless they're physically here. So I need to find in terms of means. But if we don't have a federal legislation coming from the U.S. Congress, what do I do? So in these 25 years, what states have been doing is essentially drafting their own laws. And in looking in terms of in the area of Public Law 86-272 that it doesn't cover. And that has been kind of what we call the basis point of this evolution to expand the definition of nexus. So first and foremost, the physical standard test of what we call from the basic definition was predicated on income taxes. That's where it came from. The taxes that it did not cover that were exempt were sales and use tax. The gross receipts tax, this state doesn't have, but my state does. Washington, Ohio, other states have a gross receipts tax. That's usually a gross receipts tax tends to be another form of a business income tax. That's all that it is. Excise taxes. And then usually taxes involving the sales of tangible, other than tangible personal property, what we have in terms of real estate, intangibles, and services. And as we talk about in terms of what that means is today, is that a lot of online commerce today is the sale of services as opposed to goods. And as well as when you're dealing with ebooks, streaming, these are intangible goods. So when you think about it for a moment, all of these items are not covered by Public Law 86-272. So what does that mean? States have essentially been left to interpret on their own what is the definition of taxable and then also who is taxable without having what we call any federal legislation or rules of road to determine nationally. Any questions thus far? Okay. So one of the first nexus concepts that we're going to talk about is called attributional nexus. Attributional nexus is when a business operates a retail store in a state. We'll just use Best Buy. And then, on the same token, they have an e-commerce, bestbuy.com. Same products, same prices, same everything in the state. So again, what the inference is, I can go down the road, I can go to the store Best Buy, but I buy it on bestbuy.com. The belief is it's one and the same, right? Therefore, I should have an attribution because I see Best Buy here in Arizona, and I can buy BestBuy.com. Therefore, BestBuy.com should not be exempt, right? Because the one Best Buy down the street in Chandler, you have to pay tax at the register. You shouldn't avoid paying tax on BestBuy.com. That's the point of attributional nexus. Click-through nexus. So much of online marketing is based upon driving traffic somewhere. So are most of you familiar with what we call a banner ad or a link? Like, let's say you're searching for something. Anyone like to go anywhere travel that's not as hot as Arizona? Maybe San Diego? Okay, so we look for like a hotel designation, and then we see an ad, 30% off, right? And you click that ad, and you got to hotels.com. That's called click-through, okay? And many times that you're buying software, Lacert, you're buying Drake, you may have saw an ad and you clicked on it, and it took you to the page to buy it. That's what we mean click-through. So click-through nexus is the idea that I may be selling in terms of, let's say I'm the tax software company. Who in here, let's pick on Lacert for a moment. Who uses Lacert? Okay, so let's suppose those of you who don't use Lacert, that you use Drake or ATX or Pro Series, and I'm trying to entice you to use Lacert, and I'm going to give you 70% off. And let's say that I am based in Dallas, okay? But the actual company Lacert is here in Arizona. Okay, does that make sense? I am the banner. That's all I am. Okay? So I created the ad to entice those of you to click on that to take advantage of the offer. I'm in Texas, but the actual company selling the product, Lacert, they will be in Arizona. Well, what Click-Through Nexus says is that if the ad was in Arizona, I should be in Arizona. But because I'm in Texas, see, I'm not Arizona. But on the flip side, because Lacert is in Arizona, they have a nexus to Texas. Does that make sense? Because I'm the ad, the promoter in Texas. That's all that click-through is that you have these separate parties, is that people who throw up ads may not be the same as those who actually sell the products. Because there is an actual business model revenue that people try to drive traffic and they get money, what are called affiliate commissions. And that's why they do it. And so the point is that states that legislate a model is that those that are located physically, what we call the ad or the promoters, kind of creates nexus for the people who got benefits. So think of the hotel website, the software companies, that end company who was the beneficiary of the traffic. Okay? And that's the whole idea of click-through nexus. So again, it's commonly referred to as affiliate marketing, but in the legal context, they'll say click-through. So again, affiliates will earn a commission on every sale by having click-through in terms of the site. This is what it will look like. So let's suppose you come out on a site, you're on a tax research site, we see these all the time, these promotions go, neat, it would be great to have an app for managing mileage, and I offer a free offer, or there's an association, or a calculator for a particular form, and then I click it. That's the whole point of the click-through. Now, affiliate nexus. So affiliate nexus is when we think of what we call all the different third parties. So in a business, businesses rely on the whole web of third parties, what we would call the independent contractors, sales agents, besides third-party companies who do installations, technicians, so on and so forth. So again, the concept is, the only thing that's different is that affiliates tend to be separate actual businesses, separate actual legal entities. But the point is in affiliate nexus is that it's bringing it back in together, that we're kind of related, and therefore it creates a nexus. Okay? And that's where it gets really dubious, because we're always trying to think there's supposed to be some sort of what we call a Chinese wall. If it's a separate business, separate legal entity, they're not related parties, how does it bring me in? My answer is, when you have a lack of federal legislation, this is what happens. You have essentially, individual states create rules. And right now where we're at is, we have a current Supreme Court case, Wayfair versus the state of South Dakota, to decide once and for all. But that's where we've been for 25 years. Essentially, we've been in this world of uncertainty. So states have essentially on their own interpreted and created some of these rules, because as you see, in many ways, it can be overly burdensome and overly reaching. Because think about, for most of your clients, well, if I'm shipping with another company, like a freight company, or let's say I sell products, but I'm based in California and I sell air conditioning units, but I happen to have a group of installers in the state of Arizona, how is it possible that I'm supposed to be collecting tax in Arizona? It creates the whole idea of fairness. But again, with a lack of having what we call federal legislation, this is the inevitable byproduct as a result. Okay? One of the final outgrowths or evolutions of nexus is what's called the concept of economic nexus. So, as we talked about in the prior forms of nexus, there was some sort of kind of physical element or action-oriented or based upon the relationship. This form of nexus has nothing to do with that. It's based upon revenue or economic benefit solely. So, it is, for many states, it could be a hard number of basically a % of your overall sales, or it could just be a number of 250,000 of gross revenues, or you can have 25,000 of what we call property owned. So again, it could be a hard number, or it can be a percentage of your overall. And that's what we call economically benefiting from. So you can, in other words, go through, as we've stated, in all the other examples, you have no click-through, you have no affiliates, you have no attribution, but you're just sitting from your perch, you're sitting in the state of Delaware, selling in, and you have $1 million worth of business going into the state of Arizona. That's the idea of economic nexus. You have none of everything else, but you derive enough of a business, therefore, we're going to conclude you must have a presence. That's the concept of economic nexus. And currently, where we're at, the following states have economic nexus: Alabama, Georgia, Hawaii, Illinois, Iowa, Kentucky, Maine, Mississippi, North Dakota, Pennsylvania, Rhode Island, Tennessee, Vermont, Washington, and Wyoming. When I did this presentation a year ago, it was 4. This is what's changed in the last year. There are about 4 additional states that are pending right now because they're being challenged in the courts in their own individual states. So, again, we may be looking, if we fast forward in terms of this summer, a year from now, that we'll have no states or all 50 states, because really what it's come down to, the fact that the Supreme Court is hearing the Wayfair case, we may eventually have a ruling once and for all, is basically, are you in or are you out, in terms of having this wholesale form of nexus throughout the 50 states. But in the meantime, as we're evolving, the last and ultimate form of nexus is what we call the marketplace. And so the marketplaces, as I go back early on in the beginning, as those who are selling on eBay and selling on Amazon, that is your marketplace. You're selling on the site. And what's big out here in Arizona is we have a lot of Airbnb, right? Huge. That's the marketplace. And so The concept of the marketplace is, if I sell on my independent website, it's very hard for me to go and find the little guy, right? So it's a lot easier for me to go out and legislate and say, okay, anyone who sells on Airbnb, you're automatically doing business in the state of Arizona, but I'm going to Airbnb. Then Airbnb has to enforce on their users, as opposed to going to find the individual Airbnb customers. And what did the state of Arizona do about a year ago with Airbnb? They got into an agreement to essentially Airbnb is going to collect taxes on behalf of the state of Arizona and remit to the Department of Revenue. So in lieu of the individual Airbnb operators registering with the Department of Revenue. So this is kind of one of those offshoots as a result. So currently right now, the states subscribing to Marketplace Nexus is Alabama, Arizona, Iowa, Minnesota, Oklahoma, Pennsylvania, Rhode Island, and Washington at this moment. About a year ago, it was just only the state of Arizona that had a Marketplace Nexus, but this has been one of the big hot buttons at the moment, given the fact that from an efficiency standpoint, if I can mandate the Amazon.coms, Etsy's, Wayfair's, and eBay's, Craigslist to essentially force them to pay taxes, then I can get everyone else. That's the whole reason behind this, okay? So a big question that I get from a lot of taxpayers is, when you're dealing in multi-state business, you may have occasional sales. So for example, I sell into a state, but I'm not selling on a repeated, ongoing basis. So then the question is, how long is my nexus there before I'm able to what we call unregister, what's called the trailing nexus? Each state tends to be different, okay? So in terms of in the map, usually in the green means that you have about a year of no activity. So like for example, here in Arizona, you'd have a year of no activity before I can essentially go in and say, I no longer have a nexus and cancel my registration. A lot of other states, basically they didn't answer. California, where I'm at, and a handful of states, the red just means indefinitely. That was their interpretation in terms of in their law. And so that is one of the big uncertainties that you get from a lot of taxpayers, because as you go through this analysis, they may in fact have nexus, but it's for a certain time period. It's not year after year after year. And so this is where you have to ferret out on a state-by-state basis, how much longer do you have to continue filing returns before it stops. So then it kind of leads us to believe is, how do they identify those out-of-state sellers not in compliance? Does anybody have any ideas? A little too early? Yes, ma'am.
Do they have an algorithm that goes on the internet?
That seems a little bit too sophisticated, don't you think?
I thought it was a good idea.
No, that's a great idea, but that seems a little bit way too sophisticated. Yes? Questionnaires? Okay. Anyone else?
I think when they audit in-state people, they look at all the vendors that they
Right.
do business
And what do we
with.
call that?
I'm not sure.
That's called a chain audit.
Well, okay.
Yeah, what's your name, sir?
Tom.
As Tom was stating, is the start is you're auditing an in-state taxpayer, right? And how many of you do representation or enrolled agents out here? Handful of you? Okay, and as you go through in terms of the questionnaire, what do they usually ask? We're focusing on sales tax more than income tax, but who are your major customers and suppliers? It's part of the questionnaire, right? And part of in the questionnaire is also to create additional leads. Because obviously we want to go and check if they're in compliance as well. But also too is that to prove your case, because you may have items to say, well, I didn't charge tax because they provide the exemption certificate and they're a reseller. But it's also really, it serves both ways. It creates additional leads. Any other means or ways to go out and check out-of-state compliance? Trucking stations in the back?
They can go if there's a trade show going on.
Trade shows? We have a lot of trade shows, right?
Okay.
And you always have people who fly in from out of town. They may put seminars, they may sell products, they fly in and fly out. And someone who may represent as a state taxing auditor authority under the guise of being a customer to go in and find and checking up on them.
We're also seeing a lot of the states look at the W-2 filings to see what employees are resident in their state and what companies they work for.
W-2 filings. And then also too, keep in mind, we're in a border state, and border states have a lot of customs documents. And customs documents do go to actually the state in addition to the feds. So when you're importing, exporting goods, and transferring that, they have to go through trucking stations, through actual border ports of entry, documents get filed. And that is how is a huge source of leads. But let's go back to the lady who suggested the questionnaire. What was your name? Beth. As Beth was saying, that's called a Nexus questionnaire. And in your book, I provided a sample of a Nexus questionnaire. And as we're looking at here, this is the primary tool to send out to the actual lead. So as we have these different means of identifying potential targets through the audit, through the trade show, through customs, border customs documents, now we usually send out questionnaires. And these Nexus questionnaires that go out to these potential leads is essentially to inquire, are you doing business in your state, in our state? And that's a loaded question because they have a source. In other words, usually the answer is yes, because they got it from some credible source, as opposed to you just marking no, we have absolutely no affiliation. And I'll give you a classic case in terms of, in my state, in California, is that we get a lot of taxpayers who absolutely are adamant saying, I didn't buy anything out of state. And just like Arizona, like most states, you have a use tax, right? I bought something on the internet, I bought this leather sofa, and I didn't pay sales tax, right? But now, the state of California, formerly it was the Board of Equalization, they got from a document, came through a trucking station or alternate means, they know you bought the item. And you just can't say no. I never paid in terms of sales tax. The same thing that's happening. And you're getting a lot of taxpayers swearing in terms of to you that I don't do anything in terms of out of state. So this is what you have to fully in terms of and understand, and it's testing all these individual elements that we talked about earlier about are they attending trade shows? Did we buy anything online? Are we using what we call third parties to conduct our business? Like sales agents, installers, techs, companies that promote, warehouse, store our product on our behalf. That's what these Nexus questionnaires test. And believe it or not, many of these slight indications in most of the states automatically create a nexus. That is actually the result of what happens. And usually most of the time is that the taxpayers have to register. Now the confusion that comes with it is it doesn't necessarily mean that I may have a nexus for income tax purposes. It's a nexus usually for sales tax. And that's often what is the most confusing. I may not have a nexus for income tax, but I can easily have a nexus for sales and use tax. Okay? So, usually then what the optimal or the best solution is if you can identify those of your clients that are doing business in other states. I strongly urge you to get them to engage in what we call voluntary disclosure. And the purpose is, in terms of involuntary disclosure, is you want to register first before a state ever contacts you. Why? Anyone have any idea?
Penalties.
Penalties? Yes. Any other ideas why we want to, it's in our best interest to engage in voluntary disclosure?
Start the statute of limitations.
Start the statute of limitations, right? Most states have a 4-year statute of limitations. Most states, if you voluntarily disclose, tend to look at your start date and kind of take it from there. They don't kind of tend to scrutinize too much that you say, well, I started doing business January of 2018 to scrutinize I was really doing business in January of 2014. But if I'm caught, then they usually look back 8 years. I would rather have a 4-year statute of limitations, and I'd also like to start the clock. So those are the two reasons predominantly why you want to do voluntary disclosure. In regards on the penalties, many states are actually inviting people to come in, and they're constantly running amnesty programs. And the amnesty programs essentially are allowing those who haven't been filing and complying to just pay the taxes and avoid any penalties. So that's usually what the amnesty programs allow you to do in addition. But in absence of the amnesty, the most important aspect is you're trying to reduce the amount of exposure. Because a non-filer, if you are sought and mandated and obligated to file first, then they look back 8 years. Okay? And so this is why is in terms of the imperative. And when we think in terms of in small business, most of our clients, sales tax liabilities are much larger than income taxes, right? You can have a business that sells $1 million, but for income tax, they may have a loss. They may not owe any income tax, right? But if you take 8% of $1 million, it's a lot of money. And if you got 8 years of exposure, that's an even bigger amount of money. So this is the ramifications here in terms of in the consequences of not doing it right. So it's always in terms of your best interest to engage in a voluntary disclosure. Okay, so in terms of moving beyond nexus, we want to address the next topic of apportionment. Any questions on nexus before we move on? Okay. So apportionment goes back to in terms of determining the whole purpose is how do I allocate or thus apportion a sale to a particular state. That's the whole idea of apportionment. So in the first topic, we talked about nexus, whether I'm doing business or not in that state. So now apportionment is I need to determine how to allocate, or thus what they use the means apportioning to that actual state. So the traditional method, which goes back to the early 1960s, was the 3-factor formula. Property, payroll, and sales. Now, I want to clarify in the outset that this apportionment method was for income taxes. Okay? So we're talking about income taxes. I'm not talking about sales tax. When we move a little bit later on, we'll talk about apportionment methods for sales and use tax. But right now, we're just going to be talking about income taxes, so we don't confuse anyone. Then some states opted for, okay, we take the 3-factor formula, property, payroll, sales, and then we enhance one of the factors. In other words, instead of having each of the factors have an equal third, we will boost up sales, for example. And Arizona does that. they give a higher weighting to sales than the other factors. Okay? And then finally, given the fact of the sign of the times in a more digital economy, many states are essentially doing away with the traditional three-factor formula because people don't have warehouses and payroll and employees stationed everywhere. They're resorting to what we call a single sales factor in terms of in their apportionment. So let's take a look at how the apportionment would work. So in a three-factor formula, we would take from the balance sheet here the average amount of property, okay? In that state versus the federal return, okay? Is everyone with me so far? So if you look on the left, I have about 1,482,000 of total property, and I've got 623,000 within California. Next factor would take in the amount of rents within the state, and my only facilities are in California, so thus it's 100%. So the combined two gets 65%. That's just on the property. The amount of payroll, again, in the U.S. versus in the state is a percentage. Sales, and then basically as you average it out, my apportionment allocation is essentially 41%. That's how a three-factor formula works. Okay, now let's show how an enhanced factor would look. So for example, in Arizona, we would take the sales, and then they're going to multiply it by 8. And that's all that happens. So if we had the three factors, we're just going to give a higher weighting to the sales. Any questions on that? Is that clear? So looking back in terms of what are the apportionment formulas by state, well, in my state, California, three-factor doesn't matter anyways. We're what we call single sales factor. Arizona is the enhanced sales factor. But more and more states are adopting the single sales factor as a result of e-commerce. So we're eventually, in not too distant future, where most states are just basically going to say, we don't need to figure out the amount of property and payroll in those states. What are your sales in our state? But for those of you who have clients in, as we're talking about Alaska, Delaware, Hawaii, Kansas, Louisiana, we have to figure out the amount of payroll, the amount of property in those states to properly allocate and determine the taxable portion. So sales sourcing is the word that's synonymous for apportionment in regard to the sales tax. Okay? And sales sourcing can differ for income tax purposes versus sales and use tax purposes. And when we think about the types of goods that we sell, sales of tangible goods, generally speaking, are sourced to the destination of the purchaser. So as if I'm buying computers and furniture and any other clothing, electronic, any of the usually physical goods, we think of basically the customer of sourcing it as that destination, what we call the purchaser. Now, the sales of services and intangibles, they're sourced to where, this is traditionally speaking, where the services were performed. What do all of us perform here? Services, right? And services were traditionally sourced to where they were performed. So if you are working and operating and doing bookkeeping and taxes here in Phoenix, traditionally speaking, they were sourced to where you did the work. Okay? However, again, many of these concepts have evolved, but I'm just talking about traditionally how they were sourced and allocated. So in talking about services, how that was determined for those that you had offices in different states, it was called the cost of performance method. And we had three methods of determining that: the plurality, majority, and proportionate methods. So let me give you an example. ABC Bookkeeping provides online bookkeeping to small businesses throughout the U.S. ABC is based in California, but employs bookkeepers in California, Oregon, and Utah. ABC performs contract billing services on behalf of several large retirement home communities in Arizona. So as we see in terms of from this example, we have a multi-state business enterprise where I'm based in California, but I have some payroll and staff in 3 different states, and then also the customers I'm serving is in a totally different state. In 2017, 40% of the bookkeeping cost was attributed to California employees. This is the actual payroll paid. 30% to Utah, 30% to Oregon. So this is how it worked. On the plurality method, all income would be sourced to California. That's if the state subscribes to what's called the plurality method. The majority method would go to nowhere because no single state eclipsed 51%. The proportionate method would be 40% to California, 30% to Utah, and 30% to Oregon. This was the traditional method of sourcing services for many decades. However, as of recently, in the last few years, a lot of states have essentially been doing away with this traditional means to going to what we call as market-based sourcing. And market-based sourcing just basically states is that where were the customers being served for this bookkeeping company? It was in Arizona, right? But the business was in California. They had employees in California. They had employees in Oregon. They had employees in Utah. But the market in this case was Arizona. And that's what the whole idea of market-based sourcing is. So states are now trying to legislate on services, because this is what it applies to, services, is that, well, you must be doing business in the state because you're serving that market, even though you're not physically here. Does that make sense? That's the concept behind this. Because in today's day and age, you can use QuickBooks online. You can use email. You can get online banking. You don't have to physically meet with the clients in your office, right? So you can do, in this example, a multi-state business, and it happens all the time. How many of you have out-of-state clients and have mail-in clients? Most of you. That's the idea behind market-based sourcing, because they're kind of saying, well, wait a minute here. You're kind of like doing business in our state. And this is the latest trend, is essentially moving towards where, believe it or not, we're like a 50-state business, even though we're a small business. And that's where it seems like, in a way, a bit of some insanity. Because maybe you do one return to North Carolina. You do one return to Maryland, right? You do one return to Ohio. But you're going to register in all those states for each one of those clients? It seems insane. But this is the current trend of where we're at today. So again, under market-based sourcing, the sale, what we'd call, would be sourced to where the customer lives. Okay? And in my state, we're starting to legislate market-based sourcing, and many states as well are legislating market-based sourcing, just so that you know. And so this is what you have to stay tuned to. Okay? How many of you here are baseball fans? A few of you? Don't like the Diamondbacks? Okay. I'm a Padres fan, but they've been playing like a minor league team, so I'm not going to talk about them too much. I'm going to talk about what's called the throw out and throwback rules. So, in the beginning of a baseball game, we have what's called the opening pitch. Someone comes in, throws an opening pitch to the catcher, right? So that's what we call throw out. The catcher throws back the ball. Throw back, right? So in terms of in taxes, throw out and throw back is basically when we're trying to talk about in those cases where we have a sale in nowhere. Okay? So as we talked about allocating to all these places, we might have a jurisdiction, right? Theoretically, there may be a place where there's nowhere. That's the point of throwback and throwout rules. Because the throwback rules is just to determine you can't escape taxation, right? So we can either, for apportionment, throw it back, meaning to your home state, or we can throw it out of the calculation. Does that make sense? So let's kind of work through the example. So let's take our sales factor formula, okay? Take our sales within Arizona divided by our sales nationwide. So with our numerator and our denominator, that's how we find the percentage. So when we talk about the throwback or throwout, if we're in a throwback situation, Arizona would say, those sales out into Nevada, the nowhere sales, I'm throwing them into the numerator for Arizona. I'm counting them. Are you with me here? That, what I mean, is thrown back. If it's a throwout state, I would reduce it from the total sales, the denominator. I'm throwing it out of the total sales. So thus baseball, throw back, and then the catcher, throw out. Got it? So let's go back to the beginning. I'm in Arizona, I have some Arizona sales, and I have US sales. The numerator is my sales within Arizona, but those sales I'm selling into Nevada, no taxes, nothing. I don't get away with it. So I'm going to throw it back into my numerator. If Arizona is a throwout state, Arizona is just going to say, throw it out of your total sales. Okay? That's just your adjustment, and that's all that it means. So in other words, just so that you know from a layman's standpoint, you can't get away with sales that aren't taxed. You got to adjust it somewhere. Okay? That's all that you do. And so in terms of in the map, most states are what we call in terms of a throwback state. The actual in terms of throwout, we only have in terms of a couple like West Virginia and Maine, but most states is what we call in terms of this throwback principle. You're just going to add it back to the numerator. Okay? All right, so let's talk about sourcing for sales tax. So we have two in terms of fundamental concepts of sourcing for sales tax. We talk about origin-based and destination-based. Origin-based refers to where the seller is, or let's say where the streaming or the download is created. The destination is where the customer is. Okay? Those in terms of two concepts. So when we source for remote sellers versus an in-state seller, we can have two different rules in the same state, believe it or not, of how we source it. But most states, essentially, for purposes of a remote seller, they are going to use what we call the destination approach, or the delivery address. Only a handful, Arizona, California, and New Mexico, use origin-based sourcing for their remote sellers. So for example, if I'm in San Diego, that's the origin. I'm selling and shipping my goods from San Diego. If I'm from Phoenix, I'm sourcing, shipping my goods from Phoenix. Versus I'm in San Diego and I ship to Phoenix. Okay? The recipient is the destination. A handful also permit the actual sellers to remit on what we call on a flat rate. So like for example, in the states of Colorado, Illinois, Indiana, they have a statewide flat rate for its remote sellers. Unfortunately, that's few and far between. Most states tend to basically, you have to calculate that rate for where the customer is in their local zip code and locality. And thus, this is what creates the complexity, because when we look at, through the U.S., of the origin versus destination, most states across the U.S. are destination-based. And this is where we get in terms of what we call the compliance nightmare. Because when you essentially extrapolate this out through the U.S., that's 55,000 different tax rates. It's extremely arduous and extremely error-prone. And thus, in terms of the need that you need to implement some level of automation. Unfortunately, for a lot of small businesses, it's very costly, that automation too. Because most of the software that's out there, when you're thinking of like Avalara and the other competing platforms, they tend to charge per transaction. And so if you're paying 50 cents to $1 a transaction, that can add up to a lot of money. And these are for what we call sales tax calculations. Okay? So thus, again, the need of having some sort of federal legislation to not only level the playing field, but wouldn't it be nice if we can harmonize rates across the U.S.? Seems too easy, right? But when you go to much of the globe, and when you look in terms of in their taxation, the common parallel of VAT tax, they're federally based, and it's a common rate for the nation, as opposed to having different provincial rates. Now, like Canada has some different provincial rates, but they have worked to harmonize their rates across Canada as well. But this tends to be the trend globally, is to have a national rate versus these individual locality rates. Because in a world of e-commerce, this is what you get into. It ends up becoming a nightmare, and then it could be a detractor to compliance, because then you've gone through this and essentially you've educated your client. Yes, you have a nexus. Yes, there's a tremendous amount of liability, but then when they look at this, many may opt to, you know what, I'm just going to take my chances, because this is just too much. Does that make sense? And this is essentially the dilemma. Yes, Terry.
So what you're saying here is that, like in Arizona, our rules would apply no matter where the sales went.
Right. So like, for example, as I'm operating in California, and I've had a lot of clients who are selling in Arizona, and here's the frustration is, you register at the Department of Revenue, and in the past, you had to register with the city of Chandler. You had to register, with Scottsdale. You had to register with Tucson. So I had 2 returns. And then in reality, as I'm selling from California, I didn't sell every month into Tucson. I may have had 1 or 2 sales a year, but I still had a filing requirement. You see how it multiplied by all the cities? And that was like as a frustration in Arizona as one example. Now what Arizona has done kind of lately is a lot of these bigger cities have been rolled into the Department of Revenue, but it wasn't like that. But, a few years ago, where you had to register with the city and register with the state. But now they've kind of been consolidated. But there are a number of states that do that, where Louisiana, you have the parishes, and the parishes is the city, county, that you remit to the state, you remit to every parish. And so the out-of-state seller has to not only calculate the rate for the locality, they also have to file for not only the state and the locality. So thus I have an additional administrative burden.
But if you're in California selling in Arizona, according to your chart up there, we're both origin states. Okay.
On the state level, but not the locality. Because under the original rule, it was hybrid.
But from California to Arizona, wouldn't the California tax be collected versus Arizona?
Not if I had Nexus in Arizona.
Well, if you didn't have Nexus.
If I didn't have Nexus, then it's the Arizona customer. It's a use tax situation. I'm out of the equation. But the whole point of what we've been talking about all morning is this evolution more and more. There's a probability that I'm actually doing business in Arizona. And thus in the complexity, because of those of you who've been Arizona practitioners that I find, I've got the state and then the localities had their own rules, and they weren't what we would call coordinated. Yes?
If they went to a national sales tax, it seemed like, it simplifies it because the rates then become the same.
Harmonized.
We still have the same issue of problems. Is it origin-based or destination? How is the national sales collection going to be allocated back to the states?
Well, first of all, how it would happen is in terms of if you take a parallel of VAT is that you tax everything. okay? Which a lot of people wouldn't like, because what we sell, we'd be collecting taxes, so all your services. And then, and secondly, a lot of times they would be allocated based upon the actual taxpayer or formula. In other words, there's software or technology that can say is the customer, let's take the customer billing zip code, that you can allocate automatically on that, or you can default the registrant where their domicile is. In other words, there has to be some sort of negotiation.
Yeah, some states will lose under the origin, some will gain under it, some will lose under destination.
Right, but in reality, let's take federal taxes, for example. We all pay federal taxes, but by no means, I'm in a state of what, we're 38, almost 40 million people. We actually, a lot of taxes go in terms of other states because it goes in the federal coffer, and the federal coffer divvies it out on whatever formula or how they legislate it. In theory, you know, that's what we call an act of trust, is that they divvy it out. Or if you want to go a strict allocation, there has to be in terms of some sort of rule that every transaction has certain elements like a zip code or something to determine the allocation. On VAT system, they have very strict invoicing requirements, and that's how it works, is because they have customer, destination, all those particulars. So if I'm a U.S. company selling into the European Union and it's going into Germany, they know that it's actually for the benefit of a German customer in Berlin. But in the U.S., we don't have invoicing requirements because it's kind of like we don't mandate those rules, but if you're trying to get there, you kind of have to mandate those rules. Does that make sense? Ruth?
Isn't this also assuming that if we had a national sales tax that there would be no more state, which I don't think would be the situation. I think it would be a tax on top of what the states are doing.
Yeah, and that's a challenge because Ruth makes a valid point, because the whole idea of a national sales tax would be to replace the state sales tax and just make a level playing field. But what it means is it's a windfall for some states because 4 states don't collect the tax. And then for other states, it's a haircut. But again, when you look at the 21st century, the model that was built for a time that we did all of our business within 4 walls and we drove down the street. And local citizens can go and determine, do I want a bridge, do I want a stadium, do I want a school? I'm just telling you, when you bring it out, it's insanity. So despite we talk about all the obstacles, a national sales tax is not a bad idea, because let's just take compliance, for example. Let's assume that this Supreme Court decision, which may come out fairly soon or at the end of the summer, says, you know what, state of South Dakota, you're right. They're doing business. And so is everyone else. Done. End of subject. What does that mean? All of our clients, all of a sudden, are subject to this. And the complexity behind it is we've been talking about in terms of in the rate. Okay, I'm subject to tax is one thing, but what's the rate? And then the rates change. They change all the time. And there's an inherent cost behind that, because the software to keep it automated, or if you're using QuickBooks or an accounting program and you do it in a manual basis, that's the administrative burden. And then, as I've been stating, because I've been doing this for years for clients, you may just have occasional sales. I did it a couple times. But then I'm not selling again into Flagstaff. I did 1 or 2 sales into Flagstaff. But do I have to keep filing quarterly to Flagstaff? That's the problem behind this. So you can all of a sudden create a legislation or rule where everyone has to comply, but then it makes it near impossible to encourage compliance.
William?
Yes?
Wayfair came down this morning about an hour ago.
I'm sorry?
Wayfair papers came out this morning.
Okay, what's the verdict?
South Dakota won. The
Bingo.
court laid out that South Dakota's law has no burden to interstate commerce, but made clear that more complex and overreaching laws would be.
Yeah. And obviously, it's a little early to interpret it, but again, it's what I've been saying. It just, in plain English, means it's a green light. Okay? It's a green light for states to essentially, Terry, you're doing business in Washington, buddy. I'm not in Washington. You see what I'm saying? It's a green light. So then, therefore, it's a punt to the Congress to basically, you have to create a rule. Because if you don't, well, the state of Wyoming has said, Tom, you're doing business in Cheyenne. What do you mean? Right? But if you don't have federal legislation, that's where you're left
So
with.
what happens to the U.S. Constitution in all of this?
Huh?
What happens?
Well, that was the point of the case.
Yeah.
Because it was tried on the constitutionality.
Right.
And the state prevailed. And this is, and Terry, this has been going on for 25 years, that other cases were brought up and they were thrown out. This is the first time in 25 years that the Supreme Court decided to take a case. And time again in the last 25 years, you know what they said? This is the U.S. Congress's role, their jurisdiction. They need to determine what is the playing field. And it never happened. Nothing. But as I talked about in the early portion, there are certain what we call workarounds, right? And states latched onto those workarounds to evolve from everything that we were taught was physically being present. But it was only in the initial decision for income taxes. It didn't cover everything else. And then it also didn't cover was the digital economy, which is largely services and intangibles, right? It was meant for physical goods. So as you see, there's a huge swath out there that Quill versus North Dakota from 1992 didn't cover. And that is kind of how you see, like the tentacles, how they grew out. And without federal law. And so again, as we have in this case with South Dakota and Wayfair, states now have free license to go out and legislate absence of federal law. That's what it means. How are we doing on time? Huh? 9:05, so about 10 minutes?
No, about
25 minutes? Okay. All right. So let's talk about, prior to our break here, is a few of the big hot button issues. So one, we're going to talk about drop shipping. Drop shipping is how a lot of e-commerce has been facilitated over the years. It has allowed basically people to have home-based businesses sell on Amazon, sell on eBay, Etsy, and Wayfair, and drive a lot of revenues because they don't have to store or hold any product. They essentially engage in third parties that they order the product on a real-time basis, or they store the product on their behalf and ship directly to the customer. That's what they mean by drop ship. The challenge, what's happened in the last 20 years, is that a lot of these sellers were always saying this, I'm not here. I'm not in Arizona. But many of the drop shipping companies were. They were warehousing and storing their products out here. So a lot of states have enacted drop shipping regulations to essentially state that A is where the drop shipper is located, is the presence. So that's a physical presence. And essentially also who should be collecting it. So usually, for example, if the drop shipper is selling it to the, let's say the Amazon store, and the Amazon store collects the money from the customer, the drop shipper who's in Arizona should collect the tax from the Amazon store merchant. Does that make sense? If the Amazon store merchant is registered here in Arizona and they collect tax, that would be a resale from the drop shipper to the Amazon store, and then the Amazon store would collect tax from the customer. Okay? If neither were operating here, but the customer received the goods in Arizona, then the customer has a use tax. So that's the trio behind drop shipping. So let's talk about the cloud. So when we talk about in terms of the cloud, we're usually talking about computer software. And when we're discussing in terms of the taxability of computer software, we have to answer in terms of the basic premise, what is being sold in order to determine its taxability. Is it an intangible item or is it a service? Is the software canned? We all here use a tax program, right? That's canned. It's not made for us. It's made for the mass group. If we made something specifically for our office, that's custom, okay? You use QuickBooks, that's canned. If you have someone program a specific accounting for your office or what you need, that's custom. Why does it matter? Because that is essentially the basic framework of determining whether this is, from the context, taxable, tangible personal property, or it's just a service. That's why it matters. So let's look at canned versus custom software. Again, canned software is pre-written and made for widespread commercial use. Microsoft Office, Adobe Acrobat, our tax programs, our accounting programs, so on and so forth. That's your typical commercial canned software. Okay? Regardless of the means of distribution, most states are going to view this canned software as what we call tangible personal property. And if it's viewed as tangible personal property, they tend to view these items as being taxable. I happen to be in a state that says, well, you know what? Downloads and certain items are not tangible personal property. We kind of have that little bit of an exemption right now. But most states, believe it or not, say the downloads are tangible personal property versus the actual physical CD. Okay? So this is a state-by-state difference. Custom software, on the other hand, tends to be viewed more as a service because it's made to the specifications of one customer as opposed to a widespread audience, even though they tend to do and perform the same thing. But this tends to be the distinction in terms of its taxability. So currently right now, when we look at pre-written software that's taxable, that's delivered electronically, the red swath of the map is where it's currently taxable. So as what we're talking about, those downloads down here in the southwest, Arizona, New Mexico, Texas, downloads are all taxable. In the green, in those states, downloads are not taxable. So what are all the downloads? All those ebooks that you buy. You get those Netflix, get those music, iTunes, Spotify and all that. All those typical downloads and streaming, that huge swath of the economy. Most of the U.S. is taxing those items, except for those states in green. Okay? Cloud computing. Any of you here use some online-only programs? Are you still installing and using programs so like you take the tax software and install your computer? Or are you using like a QuickBooks Online? How many here use online programs? A handful? Well, believe it or not, you know, probably 10 years from now, almost all of us, we won't have a choice. Because part of the reason why is the updates. We get our updates immediately. Two, it's the business model. How many of you, you bought QuickBooks, but you never bought the upgrade, right? And so you're operating off of a 2012 QuickBooks, and it's 2018. Well, Intuit, I don't get to make money off of you, right? But if I sell you the online, I have a subscription, I have a revenue stream. So it wouldn't be surprised that almost all software goes that way eventually. Okay? So there's still a lot of uncertainty in terms of, in this arena, what we call cloud computing, in terms of the taxability. The primary issue that is yet, when we're looking in terms of being adjudicated, is whether cloud computing is a tangible personal property or is it a service. That is what's yet to be determined. And that is, again, another fundamental challenge here. When you go out to much of the globe in a VAT system, they tax everything. You don't have the uncertainty. But again, here in a context of state sales taxes, we tend not to tax services. That just tends to be a principle of our taxation. We tend to tax goods. And so, again, if these online-only programs, if they're services, they don't get taxed. But if they're goods, they get taxed. But if more and more software is going this way, you see how you can eventually have an eroding tax base. That's essentially in terms of the challenge here.
But almost everything is software. I mean, your Verizon operating system on your phone is software.
It is. But these laws were made before cellular phones. All these laws that we talk about in terms of the initial nexus, the rules for apportionment, we talk about tangible personal property, was made in the late 1950s and early 60s. And they have failed to kind of keep up and evolve with a world of virtual and digital goods. And that's the challenge that we have. So if we look at the strict sense of a service, it was thinking in that world that you kind of have like a repairman, right? And you fix the refrigerator. As opposed to, I am buying a whole magazine and a whole book and reading it on my e-reader. And that's essentially is what the challenge is. And if you keep that strict interpretation, you will eventually have a disappearing over and over tax base. Because if we just state simply, we're not going to tax services whatsoever, and we're going to call all these new innovations services, fewer and fewer people are actually going to be paying taxes. That's the reality. Okay? All right. So when we talk about SAS, we're talking about software as a service. Software as a service is the typical commercial term of online programs, or what they call cloud computing. That is the marketing term that they use. Okay? So for right now, which states that they do tax online programs? Again, we're thinking of QuickBooks Online. I use for taxes what was called Intuit Tax Online. It's now called ProConnect. That's the online. It would be Arizona, New Mexico, Texas, Utah, the green-colored states for right now. It's a minority of the states are taxing the online program. Okay? That's for right now in 2018. Maybe fast forward a few years, most states will realize that is insanity and not the way to go. So this is kind of where we're kind of in a state of flux for right now. Okay, digital goods. So when we talk about digital goods, we need to kind of create certain definitions of what they are. So when you're determining in terms of when the states are legislating how they go about and tax them, we're talking about digital products, digital audio works, and digital audio-visual works, and finally, digital books. The purpose of these definitions, and when you're finding these laws that come about, there is a consortium of states that get together to determine and kind of create what we call this commonality. It's called the Streamlined Sales Tax Commission. And so these are kind of the working definition, rules of road, or principles, the framework that they're creating. Again, the whole purpose is when we extrapolate this out, we don't want to have 50 states and 50 different rules. Some point, we've got to get to a little bit more parity. We're not going to have perfect parity, but again, that's the objective of the Streamlined Sales Tax Consortium, to basically have some sort of working framework. So digital products are those that are transferred electronically. The ebook, okay? Digital audio-visual works, we've got our Netflix, right? Digital audio works, all those iTunes and music, okay? And finally, again, digital books, I mentioned in terms of ebooks, okay? but digital products as, I'll give another example, video games, huge market. And online gambling, right? Digital product. Okay, so right now in terms of the taxability of digital products, so far we have 18 states right now that actually tax digital products right now. Majority of states are either trying to interpret what they are to create a law, or they don't tax them right now. Okay? So that is kind of the frontier of where we're at, is with this whole outgrowth of digital goods. Okay. All right. How are we with time on that?
15, right?
Huh? 15 minutes?
15.
Okay, so about 10 minutes? I'm sorry.
15.
15 minutes till the break.
Okay, 15 minutes. Okay. All
If you
right.
want to go now, we can.
Huh? No. I just was trying to look in terms of in the placeholder here. All right. So, what we're talking about in terms of in the workforce here, so we're kind of in the second pillar of what we call virtual work. And a lot of what we call it in terms of the catalyst here goes back to the housing crash of 08. But we've also had for a long term of trends as a result of the ease of using the internet and communication technology, more and more people have been able to work remotely and work from home, is what we call in terms of telecommuting. But what I call is the huge catalyst as a result of the housing crash is that we had a large swath and group of people out there who just were having difficulty finding work, had little job prospects, and thus found themselves in what we call the gig economy. And thus, we have this phenomenon of people out there who are either becoming Uber drivers, who are becoming, babysitters at home, or they're out, delivering items, like as you have TaskRabbit, or renting out rooms in their home, so on and so forth. This has been the evolution in terms of in that. From an economic standpoint, the definition that is used is what's called a contingent worker. And the contingent worker is the definition that's used by the Bureau of Labor and Statistics to encompass all of what we call non-traditional forms of employment. Okay? So it would basically, any type of work that's what would be non-permanent, or what would we consider working on a part-time basis or an alternate arrangement. That would mean a freelancer, an independent contractor, part-time employee, temporary hire. These are all in this huge bucket out there of what we call a contingent workforce. Now, the slang term or colloquial term that's often used in today's day and age is a gig worker. Okay? And I've had in a few of these presentations saying, this idea of gig worker, where does this come from? Well, what's kind of interesting is it's a very old term because it goes back to musicians. People who are going from bar and venue to venue trying to get a gig that would pay, that they would make a little money and survive. And here it's become, kind of commonplace, the term for people who are putting together this whole collection of different work. And it's kind of, interesting as I've, taken a few of these Uber rides, and you're chatting with your driver, you would ask, what do you do? And I remember one lady saying, well, I'm an Army reservist, and the day I'm working at UPS, and at night I'm an Uber driver. That is a classic gig worker because you're taking multiple forms of employment to create your one whole set of income. That's essentially what they call gigging or being a gig worker is. So as a sign of the times, when we look in terms of the numbers by the workforce, the vast majority tends to be what we call in other types of services, which would be in our arena, we're in the professional scientific, but the other services that you think of is all the delivery drivers. You want food, you got Grubhub, right? You want someone to pick up a package for you and they bring it on a bike, like a TaskRabbit. Or you want, in terms of someone, you want to rent a car, but you don't go to Hertz, you're renting someone's private vehicle. You got Airbnb, I rent a room, I don't go to a hotel. Or I'm basically, like the Uber and the Lyft. These are all what we call in the other services. There are people who will take your pets out for a walk. Almost anything that you can imagine that you can go and find. You can probably rent a husband or rent a wife. That's another service you can put on there. That's part of the gig economy. So when we look in terms of the numbers, that as of 2005, according to Bloomberg, there were 9 million of these gig jobs. In 2015, there was an estimate of 53 million. According to the Government Accountability Office, about 40% of the current workforce is involved in some sort of gig jobs. And there's a forecast that in less than 10 years, more than half of the current workforce is going to be tied to gig jobs. So what does that mean for all of us? What does it mean? Any ideas?
Lots of W-2s.
No, Schedule C's actually. Yeah, Schedule C's, because when you think about it and you get these Uber drivers coming in, if it was a W-2, it'd be easy. But is Uber really going to W-2 all these people? They're not. They're all going to be, as much as they can, treat them as a 1099, thus you're going to push more and more people in Schedule C. So the challenge is that you're going to essentially have to deal with a large, growing number of people who are unsophisticated, who what I call, they're not used to being business people. Because when we deal with business clients, we talk about record keeping, we talk about bookkeeping, because now we have to go and do a tax return, and all those terms and elements. A 1040 is that when we've got third-party documents, 1099, with some interest, some mortgage, W-2, everything we can kind of take from there. You fill your organizer, we got a return, I'll follow up with you, and then we're done. Here's your tax return. But we have to kind of be a bit more involved, so to speak, right, when we've got self-employed. And can you imagine that you're taking large groups of people who are just trying to make a living, just trying to survive, and you say, by the way, Terry, I need your mileage log. What's mileage log? You see what I'm saying? And then they start saying is, I have all these meals. Why? I need to see some books and records, and who did you meet with, and what was it for? Oh, it was all those tolls that I was paying. We have these little toll roads. I put money into the meters. I'm putting quarters, right? I keep putting quarters. I need some log. I need some see, we talk more and more bookkeeping, but when we're dealing with wage earners, we don't have to talk as much bookkeeping, and that's the challenge, is that you're going to push more and more people who are going to end up needing in this, and they don't have in terms of a lot of money, they're just trying to get by. And then at the end of the day, we also have to explain what self-employment taxes are. What's that? Well, if Uber hired you as an employee, they would pay half of your Social Security. But the way the arrangement is, they provide you a customer, they collect the fare, you get part of the fare, but you're really running your own business. So you have to pay all of your Social Security. That's what it means. And so that is the biggest issue in terms of hurdle in getting to a large group of people out there. They may owe more money. So it may cost them more financially at the end of the day, despite claiming these deductions. So when you have to look at, kind of the comparison of, the cost benefit, yes, I get to take some deductions, But maybe at the end of the day, as I'm paying additional taxes, I might be worse off. And that's the significance, is that you can have a growing number of people who are like that. So let's talk about the types of virtual workers that are out there. We've got telecommuters, service providers, gig workers, or what we're commonly referred to as freelancers, and outsourcing providers. Okay. So, what are telecommuters? Telecommuters are those who perform a portion of their duties from home. More and more people are actually working from home. More and more companies are allowing employees to work from home. How many of you work from home? Good portion of you. I hate to go into the office. I only go into the office when I have an appointment. I just don't like going into the office. There are people who can do it in terms of all their work, in terms of them from home. And so when we think about it, the context is typically a lot of businesses want to classify people as independent contractors, right? And the fact, because I get to work from home, I don't have to dress up. I don't have to comb my hair. I don't have to shower. I can walk around in my pajamas. But the crazy thought that a lot of businesses say is, shouldn't that be an independent contractor, the fact that you don't have a dress code? It doesn't work. It didn't work. It didn't work then, and it's not going to work now. So usually what was determined in terms of what the IRS would use is a 20-factor test to essentially ferret out whether this is truly an independent contractor or this worker should be classified as an employee. And it focused on 3 primary tests, 2 of which are behavioral in terms of the degree of control and independence of the relationship. So we look at and examine the behavioral control, the financial control, and the type of relationship that is going on. One point I just want to point out, there was a recent Supreme Court case in the state of California, which was called a ABC rule. And I know that we're in a separate state, but a lot of states tend to kind of copy each other, because what happens in one state, other states try to kind of what we call take that concept and, legislate it. And so the ABC standard was just really a simplified looking at, if it walks like a duck, quacks like a duck, it must be a duck. In other words, when you strip back the layers, the case says almost everyone is an employee. There really isn't an independent contractor. And that was the result of the ABC test that they came up with. So really, when you look at it, those who are truly and only should be independent contractors are people who go out, you carry your business cards, you're invoicing, I'm acting like a business, I'm soliciting customers, because that's truly independent. Everything else, when you look at this ABC test, is really the default an employee. The challenges that we get into in today's day and age is that we only have 2 classifications. We only have employees and independent contractors. We never evolved and created a third or another way. But as you're looking at with the type of workforce that we have, is that shouldn't there be some sort of hybrid out there, or should there be a third classification? And that's kind of the food for thought that we want to ponder. So we're going to take a break for right now.
Yeah, I'm ready. So I just have a couple of announcements. Evaluations were in your manuals, so make sure you fill out the evaluations before the end of the day. Just so you guys know, the second day session tomorrow is not going to be held here. It's going to be held at the Lone Butte Casino. We sent out some emails of that. Hopefully you got it. It's about 3 miles further up the road at the intersection of southeast corner of High Reading and the 202. And we'll start at 8 o'clock tomorrow morning. So just so you're aware, we're going to be not here. We're going to be at the Lone Butte Casino. We have the exact address out if seminars in the rest of the year. This pricing that's on this is available through June 30th, which is